In this video, I want to highlight the hidden risk or the disadvantages of investing in exchange traded funds. What investors should consider if they actually want to, invest in a typical exchange traded fund. So while ETFs offers many benefits, they also come with potential disadvantages. So here are some key drawbacks or pitfalls that comes with investing in ETFs. Number one is management fees, and that management fees comprises expense ratios. So although generally they have lower expense ratios compared to mutual fund, ETFs still have management fees that can impact returns, especially if investing in specialized or actively managed exchange traded funds. They are not, free from fees. You have to they charge fees to manage, although not as much as what mutual funds charge, but all the same, you are still exposed to one form of fees or the other. And not only that, number two is trading cost. When you invest in ETFs, you are trading like trading stocks, and that will attract commissions. So depending on your brokerage, buying and selling ETFs may incur commissions or transaction fees, which can add up to your trading cost, particularly if you trade frequently, just like what is obtainable in stocks. So ETFs they equally attract fees, really. Number three is bid-ask spread. That's a liquidity cost. So ETF have a bid-ask spread which can be wider for less liquid funds, leading to additional trading costs. Usually when it comes to trading, you have the bid and ask, and then the difference between them is what we call the bid-ask spread. And generally, it could add to your trading cost, because of this phenomenon. You equally have tracking error. Tracking error, that's a deviation from the benchmark index. So ETF may not perfectly track their underlying index, resulting in a tracking error that can affect performance. So ETF generally, according to their inherent nature, they are designed to track a given index. Sometimes the tracking mechanism may not be all that accurate. In other words, the index may end up doing better than the ETF. Okay, and so that particular that discrepancy between what the ETF obtains and the return obtainable from the benchmark, that's discrepancy is described as the tracking error. It might be considerable at times, and that's a major disadvantage of investing in an ETF. It may not always obtain what is obtainable by the index itself. Number five is over concentration. And so sector or theme exposure, sector specific or thematic ETF may become overly concentrated in certain industry or trends, increasing risk of those sectors of underperforming. Generally, you have what is called the sector-based ETFs. And if these ETFs are over concentrated on certain sectors, if those sectors perform poorly, let's say for instance, the airline industry, the airline sector during the pandemic, if some ETFs are over concentrated in that sector, you discover that the ETF may end up performing poorly. So there's always that risk of over concentration, which is a huge disadvantage when it comes to investing or buying ETFs. Number six is complexities of some ETFs. Some of them have complicated structures. You have leveraged, inverse, or other complex ETFs can be difficult to understand and carry higher risk which might not be suitable for all investors. Some of them, not all anyway, have complicated structures. Some of them are highly leveraged. Some of them are like inverse. In other words, inverse here means if the underlying benchmark is doing poorly, the ETF will perform very well. If the underlying benchmark is performing very well, vice versa, the reverse could be the case for the ETF itself. So you have that particular inverse relationship and other complicated form of, ETF, portfolios as well. Number 7 is market risk, exposure to market volatility. Some ETFs are traded on exchange like stocks. So I told us earlier that traded like any other stocks in the market. So their prices can be affected by market volatility, leading to potential short-term losses. Just like stocks fluctuates up and down. Same thing is applicable to ETFs. They equally fluctuate up and down like stocks. So if they go down, it will affect the valuation of the ETF. And if they climb, if they go up, thank God, you end up making money. So consider the fact that unlike mutual funds, ETF fluctuates a lot. Number 8 is potential for over diversification. Just like you can diversify, there's always that tendency of getting over diversified. So this would result in a kind of dilution of returns. So investing in a broad-based ETF might lead to over diversification, where potential high returns from individual stocks are diluted. You have the leeway to diversify, but when you become over, the word over is somewhat negative. When you become over diversified, you may miss opportunities in some individual stocks you are not invested in because you are thinly spread, across many sectors and industries. Number 9 is lack of control. Lack of control. Generally, when it comes to ETF, they have what is called passive management. They're not the management. They're not all that active. The structure, the fund is not actively managed. And so, for ETFs that passively track an index, investors have limited control over the individual securities in the fund and how the portfolio is managed. You have no input on how the portfolio is managed because the entire characteristics, the entire structure is passively managed. They simply buy stocks or other securities based on the index they're tracking, and they virtually fold their hands and see how the index performs. You see, so there's no active management involved at all. Not only that, you have dividend distribution timing, So there's that variable income. ETF dividends are typically paid quarterly or semi-annually, that's every 6 months, which might not align with an individual investor's income needs or reinvestment strategy. Usually, sometimes, if they are giving out dividend annually or semi-annually or quarterly, sometimes your own timing of your income expectation may differ from the time the dividends are being paid out. So it will affect your cash flow, your income stream as a result. Number 10 is tax implication. Tax implication. Capital gain distribution. While ETFs are generally tax efficient, of course, some can still generate capital gains distribution, which may impact your tax liability. Although the tax efficient actually, but from time to time, that advantage may not be as high as what is expected. We have to bear with it. That's a typical disadvantage of investing, in an ETF. And so sometimes if they tend to sell a particular fund, so quickly or earlier, then of course it will attract a kind of capital gain tax because of the short-term implication of selling, an investment. You don't allow it to stay for long. If you sell within a short time, you will incur a higher capital gain tax. Number 12 is tracking error or niche markets. Tracking error or niche markets. In niche or emerging markets, ETF might experience larger tracking errors due to less efficient market conditions or liquidity issues, just like we earlier saw in the advantages, or in the disadvantages here. You discover that tracking error could still manifest in the sense that in an emerging market where you have a kind of insufficient information, you discover that the ETF may not be able to adequately meet up with what is obtainable in the benchmark, probably due to, information deficiency, that will lead to a kind of tracking error. In other words, what is the result being generated by the benchmark index is not transferred, doesn't translate to what is generated by the ETF itself. Because of that discrepancy is what is known as tracking error. Please subscribe to this channel and like this video. It will go a long way in motivating me to keep on delivering content of this nature to you. Number 13 is price slippage. Price slippage. That's that market impact, So large orders or trades in less liquid ETF can impact the market price, leading to slippage and less favorable trade execution. Usually, if an ETF is kind of less liquid, that is, you can neither easily buy or sell. In the case where there is a large order coming in, the ETF price might be influenced to rise up suddenly, and the other way around, if there's a larger sell, the price of the ETF may plummet accordingly, and so that price fluctuation because of lack of liquidity and because of the large order coming in, either a buy or sell order, might cause the ETF here to show large level of fluctuation because of the illiquidity involved. Number 14 is complicated tax reporting. Complicated tax reporting. And so there's complexity when it comes to ETF in this regard. So ETF have ETFs that involve international investments or specialized strategies may result in complex tax reporting requirements. You are invested in other countries. When it comes to taxation, you have to it might involve, a cross-border tax regime. The country involved may be having a different tax regime than what is obtainable in your home country. And so that's reporting that reflects that tax implication might complicate, the entire tax reporting involved, when it comes to investing in ETF. If it's your country-based ETF, the tax reporting is somewhat plain and easy to understand. But if the ETF is invested in a foreign entity, in a foreign country, then the tax regime there might come to play. Number 15, not immune to market downturn. ETFs are not immune to systemic risk. So like all investment, ETFs are subject to market risk and can decline in value, during broad market downturns. Just like a typical equity or stock. The trend, investor sentiments, market conditions, the environment, the economy can team up to bring about a level of systemic risk that will affect the valuation of these ETFs. So understanding these potential disadvantages help investors make informed decisions and manage their ETFs investment more effectively. There are advantages and we equally have disadvantages in investing in ETF. It's left for you to balance the two and see whether you would or will not, choose to invest in ETF or not.